Hello and welcome to Unit 2, Lesson 11 for Finance. And today we're going to continue to look at ratio analysis. We've already looked at liquidity ratios, we looked at solvency ratios, and we also just finished looking at profitability ratios. The last set of ratios that we need to look at are efficiency ratios. So efficiency ratios, they identify how well the business is keeping their expenses under control and how well they are receiving the money back from the creditors who owe them the money. We're looking at two ratios. We're looking at the expense ratio and the accounts receivable turnover ratio. To calculate these ratios, we're going to need two different statements. We're going to need the income statement and we're also going to need the balance sheet. So let's look at the expense ratio first of all and see where we get that information from. First of all, we need to know what ratio we're going to look at and how we're going to make that calculation. The expense ratio monitors the proportion of expenses to sales. It allows a business to look at if they have high costs in certain areas and try to make the management of their sales versus their expenses more efficient. It uses the income statement only. The balance sheet is not needed here. And the ratio formula is expense ratio equals total expenses divided by sales times 100 to give us a percentage. Let's look where we get the information from. So on the Amcor income statement that we have here, we're looking at the expenses, the total expenses. Now we have to look very carefully. Here on the statement, after gross profit, we can see that there are three numbers in brackets. That means minus. That means it's an expense. So we need to total the three numbers up. We've got a sales and marketing expense, a general and admin expense, and a research cost expense. If you make an addition of all those three expenses that I'm highlighting at the moment, you will see that that comes to 135270. That's our expenses. Then we need to divide that by our sales, which again at the top of the income statement is 9849.5. If we make that calculation, we get 0.137 or 13.7%. It can also be expressed as a ratio of 0.13 to 1. That means for every $1 of sales generated by Amcor, 13 cents is used in expenses. So 13% of the sales of $1 of sale is used in expenses. If the previous year's expense ratio was 12.4%, that would suggest that they are now less efficient and that their expenses have increased or their sales have reduced. The ideal is a low expense ratio for a business to generate maximum sales with low expenses. Now let's have a look at the accounts receivable turnover ratio. This is the last ratio that we're going to look at. It tells a business how many days, on average, it takes for their customers, the people they sold goods to, probably on 30-day credit terms or 40-day credit terms, to pay their invoices. Basically the turnover of accounts, how quickly they can receive the money owed. It can be used for debt collection strategies to know whether the money that is owed to you is being received quickly enough, whether you have an efficient financial management collection system. It uses two statements. You need the income statement for sales revenue, and then you need the balance sheet for your accounts receivable. So the formula is accounts receivable turnover ratio equals sales divided by accounts receivable times 100. Let's see where we get the information from. As I said, we need to look at two different statements. The first statement we need to look at is the income statement. We're looking for our sales. Again, at the top of the income statement, we can see our sales is 9849.5. we can see that our accounts receivable on the balance sheet, trade and other receivables, is 1786.80. If we make that calculation, we get 5.51 as the result. Now, we need to know how many days throughout the year, if we divide it as an average of 365 days in the year, how many days on average it takes us to get the money back from the people who owe us the money. Let's see how we do that calculation. We'll take our 5.51 result, which you can see here, and then we will divide 365 days by 5.51, which will give us 66.2 days. So on average, it is taking us 66.2 days to receive the money that is owed to us. Now, if we had credit terms of 30 days, that would not be a particularly good result. If the previous year's ratio was 8.35, that would give us 43.7 days. We can see that it is now taking us longer to collect the money than it did the previous year. Previous year it took 43.7 days, now it takes 66 days. We're being less efficient at collecting our accounts payable. Our accounts receivable. So you can see here, this allows us to be incredibly efficient and to understand how our business is running. That's the end of our financial ratios. We've completed them. Now we need to know what strategies to use to solve some of these problems.